The US tax system follows you wherever you go. That's the part most coaches who move abroad don't fully internalize until the first April after the move, when they realize a US tax return is still due, even though they haven't set foot in the United States in a year. Worldwide income reporting is the legal foundation. Moving to Portugal, to Mexico, to Spain, to Thailand, none of those changes the US filing obligation. What changes is what you can exclude or credit, what additional reporting you have to do, and which specific kind of professional you need on your team. Take this map slowly. It is the most layered of the 6. Worldwide income is the operative phrase, and it means what it says. The United States is one of only 2 countries on Earth that taxes its citizens on worldwide income regardless of where they reside. The other is Eritrea. Every other country taxes based on residency, so when you move from Germany to Spain, you stop being subject to German tax. Move from the United States to Portugal and you remain subject to US tax. You also become subject to Portuguese tax. 2 systems applying to the same income at the same time, with treaty mechanisms and exclusions designed to prevent the double tax outcome, but not designed to be easy to navigate. 5 decisions stack on top of the default sequence, which makes this map the most layered of the 6. FEIE versus FTC. The foundational choice between excluding foreign earned income or crediting foreign tax paid. State residency tests. Whether your former US state still has a claim on your income. FBAR. Foreign bank account reporting through FinCEN. FATCA. Foreign financial asset reporting through the IRS. Totalization treaty positioning. Preventing double social security taxation in treaty countries. 5 separate decisions, each with its own form, its own threshold, its own penalty for missing it. Don't try to handle this map in a hurry. The single most important call in this entire unit is the choice of CPA. Engage an expat CPA, not your general CPA. US abroad tax is a specialty practice. The general CPA who has done your Schedule C returns for the last 5 years may be excellent at domestic tax and have 0 experience with FEIE, FTC, FBAR, FATCA, treaty article claims, or country-specific reporting requirements. A wrong CPA misses the FEIE versus FTC optimization, misses the FBAR threshold, fails to claim treaty positions, and produces a US return that pays more tax than the law requires and exposes you to penalties on the foreign asset side. Get the right CPA before the first year end abroad. 5-layered decisions stack on top of the default sequence. Step A1 is FEIE versus FTC, the foundational decision that affects every other piece. Step A2 is state residency tests, whether the state you left still claims you. Step A3 is FBAR reporting for foreign bank accounts. Step A4 is FATCA reporting for foreign financial assets above a higher threshold. Step A5 is totalization treaty positioning for Social Security and self-employment tax. Each one has its own form, its own due date, its own penalty for missing it. The expat CPA from the previous slide handles 3 of these. State residency you handle, FBAR you file yourself with FinCEN, FEIE and FTC are mathematically different, and the right one depends on your host country's tax rate. FEIE, the Foreign Earned Income Exclusion via Form 2555, excludes around $120,000 of foreign earned income from US tax entirely if you pass either the bona fide residence test or the physical presence test. Wins in low tax countries where your host country tax bill is small. FTC, the foreign tax credit via Form 1116, Credits foreign tax paid against U.S. tax owed on the same income dollar for dollar, with unused credit carrying forward up to 10 years. Wins in high-tax countries where the host country tax bill exceeds what U.S. tax would have been. The expat CPA runs the actual math against your specific country. FBAR and FATCA are different reports with different thresholds, and a lot of expats accidentally trip on one or both. FBAR, the FinCEN Form 114, is required if the aggregate balance across all your foreign financial accounts exceeds $10,000 at any point during the year, filed separately with FinCEN, not with the IRS. Due April 15th, auto-extended to October 15th. Penalty for non-filing is severe. FATCA, IRS Form 8938, applies above higher thresholds, typically $200,000 in foreign financial assets for a single filer living abroad, filed with the tax return. Different threshold, different form, different agency, both can apply at the same time, and they often do. Totalization treaty positioning prevents the double Social Security taxation that catches most expats. The U.S. has totalization agreements with about 30 countries. The mechanism prevents the same income from being subject to U.S. Social Security and self-employment tax and the host country's equivalent social insurance system at the same time. The position is claimed via a certificate of coverage issued by the host country's social insurance authority. The certificate states which country's system you're paying into, and the other country exempts you. Without the certificate, you pay both. Self-employed coaches in treaty countries with strong social systems usually pay through the host country and exempt out of U.S. self-employment tax, which is a 15-point savings. Anika is the kind of example that shows how all 5 decisions interact in practice. U.S. coach living in Portugal under the non-habitual resident regime. $80,000 of revenue from U.S. clients in year 1. With an expat CPA, FEIE excludes the $80,000 from U.S. income tax. Totalization treaty exempts her from U.S. self-employment tax because she pays into the Portuguese social system instead. FBAR filed for her Portuguese bank account because the balance crossed $10,000 mid-year. FATCA not triggered because total foreign assets stayed under the higher threshold. U.S.-Portugal Treaty article claimed on the residual amounts. Clean filing. Without an expat CPA, U.S. self-employment tax stacked on top of U.S. income tax, FBAR missed, treaty position not claimed. A 4-figure mistake at a minimum. Run the FEIE versus FTC decision worksheet before the first call with the expat CPA. Open the worksheet in the resources for this unit. Plug in your projected U.S. client revenue, your projected host country effective tax rate, and your residency profile, bona fide residence test, physical presence test, or neither. The worksheet computes both calculations side by side and flags which one wins at your projected income level. Bring the output to the first call with the expat CPA. Don't try to file the first year abroad yourself. The exclusions, credits, treaty positions, and reporting requirements are coupled tightly enough that a single missed piece undoes the savings on the other side.